Hello traders, welcome back to the Forex Gig. In today's video, we are going to be talking about price rejection candlesticks and a crucial concept in our price action trading strategy. This formation can signal significant market reversals and provide high probability trading opportunities. Understanding how to identify and trade this candlestick can dramatically improve your trading results. So stay tuned and as we delve into the essential trading technique that can help you spot potential market turning points with greater accuracy. Now, what are price rejection candlesticks? Price rejection candlesticks are powerful indicators that can reveal where markets strongly refuse to accept certain price levels. This formation often appears as long wicks or tails on candlesticks, signaling potential reversals and showing us exactly where significant trading activity is occurring. To identify a price rejection candlestick, look for these characteristics. One, a long wick, typically at least twice the length of the body of the candle. Number two, a small body relative to the overall size of the candle. As you can see from this example, in case of a bullish rejection candle, you can see it here. Small body relative to the overall size of the candle. Now the wick is pointing in the opposite direction of your prevailing trade. The wick is pointing in the opposite direction of your prevailing trade. These candlesticks form when price moves sharply in one direction but then reverse, closing near the opening price. This action creates a visual representation of the market's rejection of these extreme price levels. Understanding this formation is crucial because they often precise significant price movement. Now, how do we get a high probability rejection setup? When it comes to price rejection candlesticks, the most reliable setup occurs at key support and resistance. Let's not forget, it must occur at a key support and resistance level. This area represents price points where the market has historical reacted, and when a rejection candlestick forms, it can signal a strong reversal. Once you have identified a price rejection candlestick at a key level, your next step is to confirm your entry. Now, there are some guidelines when you are trying to enter a trade based on price rejection candle. Now, the first step is to wait for the candle to close. You always wait for the candle to close. Once the candle close, yes, you are ready to take such rejection trade. Number two, it's called the 50% rejection rule. You have to, ideally, the wick should make up of at least 50% of the entire candle. The wick should make up of at least 50% of the entire candle. If you can look at this place, you will see that there are two rejection candles, this one here and this one here. This first one, you can see the wick is larger than the body of the candle, so this has already covered the second rule. Now the third rule is the market context. You must ensure that this particular rejection candle must border with market structure. It must happen at an area of support or resistance. As you can see, price is on a support line because price have reacted from this area for a while. Price has been reacting, so this is actually a good sign. And as you can tell from the trend of the chart, you will see that the market is trending upward. As you can see, there's a sign that shows that the market is trending to the upside. So this is one of the guidelines. This is the last guideline you can actually use in spotting or taking such trade. Let's not forget that, let's look for a bearish example. As you can see, bearish example, this is on the key level. Price has reacted from such place. This is on the key level, this is support turn resistance. When price broke, it came back to retest the resistance, and it is a strong resistance. As you can see, price is trending towards the downside. This is a bearish trend, so this has already covered a lot of our confluences. And as you can see, if you want to take such trade, if you want to take such trade, you would have to enter it enter the trade at the close of your rejection candle. You enter the trade at the close of your rejection candle. Let's not forget, this is a rejection candle. As you can see, price rejected first. There was a first rejection candle, second rejection candle, third rejection candle, and the wicks are longer than the body of the candles, as you can see. So we put our entry at the close of the candle. You put your stop loss above the wick. Then you can target your 1:2 or 1:3. Let's not forget the stop loss placement. It must be beyond the wick. Let's not forget, to be safe and to give yourself enough room. You are protecting yourself from further losses. The risk to reward should be at least 1:2. Let's enter a trade and try as much as possible to trade, to gain or to make profits more than to make profits of such more than what we are willing to risk. If we are trying to risk 1% of our account, we make sure that our profit should be at least 2%. It gives us the edge in the market and gives us the opportunity to be able to stay in the market for a longer period of time. Then the number 3 rule to managing your risk effectively should be your position sizing. Always adjust your position size based on how far away your stop loss is from your entry point. The large distance between your entry and your stop loss, the smaller your position should be to maintain a proper risk management trade. Now there are some common mistakes we need to avoid when taking such this price rejection candlestick rejection trade. The price rejection candlestick trade, we need to avoid certain mistakes. Now the first mistake we need to avoid is ignoring market context. We need to always take trades when the market is showing us a proper direction, because it's one of the biggest error when focusing solely on the rejection candlestick without considering the market structure. Remember that a price rejection is most powerful when it is aligned with the overall trend and key support or resistance level. Now this is an example of a rejection candle that was in a sideways moving market. As you can see, the market is moving sideways, and we can't trade such sideways, and we can't we should not be trading in such market condition, because when the market is moving sideways, there is no exact direction of the market. As we can see, this candlestick, the proper rejection, but it's in a sideways moving market. We have to ignore that. Then the second rule, the second mistake we should avoid making is over trading minor rejection. It's not all the rejection you want to check, you want to trade. You see a little rejection, like as I can see one here. We see a little rejection and we would want to take the trade. No, we have to trade. Many traders fall into the trap of trying to trade every single small wick they see. Any small wick, they will want to take the trade. we need to avoid such mistakes. Den thirdly, we need to avoid neglecting our volume bar. Our volume bar is also a confluence or a tool that can help us with more confluences when trying to take a trade. Like dis example I used before from dis support that turned resistance area. If you can look at it, when we are trying to take such trade, the area where we saw a bearish rejection occurring, you can look at the volume bar, shows that yes, that price is going to react violently because of the volume bar. The momentum on the volume bar shows that there are a lot of participants, traders in the market trying to do something in the market. So we should always try as much as possible to avoid neglecting the volume bar. It can be a good indicator for us. So I believe we have come to the end of this video, and we are thankful if you have stayed to the end of this video. Price rejection candlestick is a very powerful tool in our trading arsenal. Remember to always consider the broader market and the broader market context, and avoid common pitfalls we discussed earlier. Practice spotting these patterns on your chart, and as soon as you are able to identify the potential reversals, always study it in such a way that you can identify the potential market reversals with greater accuracy. If you found this video helpful, please hit the like button and subscribe to the channel. Do not forget to turn on your notification bell to stay updated with our latest trading insight. Thank you for tuning in, and until next time, happy trading.